What happens if you get assigned on a put credit spread? Have you ever wondered what it really means when you get assigned on a put credit spread? Let's break it down in simple terms so you can understand what happens next. A put credit spread, sometimes called a bull put spread, is a strategy where you sell a put option at a higher strike price while buying another put option at a lower strike price. This creates a situation where you receive a net credit upfront, which is the premium you collect. Now, if you get assigned on the short put leg of your spread, it means that the buyer of that put option has decided to exercise their right to sell you the underlying stock at the strike price of your short put. This typically happens when the stock price drops below that strike price before expiration. So, what does that mean for you? First, you will be obligated to buy 100 shares of the underlying stock for each contract you sold at the strike price of the short put. For example, if you sold a put option with a strike price of $70, you will have to buy those shares at that price. But there is a silver lining. Since you also bought a long put option at a lower strike price, you have the right to sell those shares at that lower price. This long put acts as a safety net, helping to limit your maximum loss. Let's look at a practical example. Imagine you sold a $70 strike put and bought a $65 strike put, collecting a premium of $1.50. If you get assigned on the $70 put, you will buy the shares at $70. Then, you can exercise your $65 put to sell those shares at $65. This results in a loss of $5 per share. However, since you collected that $1.50 premium, your net loss will be $3.50 per share. This is your maximum loss for the spread. Now, what if the assignment happens before expiration? Early assignment can occur if your short put is deep into money. You will need to be ready to buy those shares and then decide whether to exercise your long put or close the position. On the flip side, if the stock price remains above the short put strike price at expiration, both of your put options will expire worthless. In this case, you keep the entire premium as profit, which is your maximum gain for the spread. In summary, getting assigned on a put credit spread means you will own the underlying stock at the short put strike price. However, your long put option limits your downside risk by allowing you to sell the stock at the lower strike price. This strategy helps you know your potential loss upfront, making it a defined risk approach. It's important to manage your position carefully, especially if the stock price approaches or falls below the short put strike price.